like how it actually propagated through the globe?
No, I've looked at the history of chocolate, and that
Okay.
was always fascinating. Obviously, given the kind of the subtropical migration, and then the creation or concoction of sugared chocolate, and then the introduction of chemical processing, of chocolate to create kind of what we think of today, and then the whole evolution to commercial chocolate. But coffee, I know far less about. I think it is an Arab thing, though, right? Like brewed with spices originally from a
Yeah, I
historical
mean,
perspective.
well, originally it was an Ethiopian thing,
Okay.
obviously. So coffee only really grew one place on the planet, which was Ethiopia.
Wow.
And when the settler, when like the colonizers, I guess, found out about this, they started moving it up into Europe. I believe, don't quote me on this, from what I remember, it was like the King of France had the first greenhouse in Europe built to try to grow coffee
Amazing.
in Europe. And I think it went up through like Yemen and Turkey. It really spread into there first and then over into Europe. And from the other story I kind of remember, again, don't quote me on this, I'm gonna have to look it up, but it was either Portugal or Spain. Someone was trying to move a coffee plant to South America.
Mm.
And the ship got stuck, like wind died, ship got stuck in the Atlantic. And it got so bad, the captain was actually sharing his water rations with this coffee plant. That's how important it was to try to get it
Right.
to South America to
Had
grow.
to get there.
Yes, it had to get there because they understood that it was going to be, I mean, it was going to be huge for their economy. They could grow coffee in that subtropical climate and then bring it back into Europe. It was like gold, even at that point.
There was a point in time historically in sub-Saharan or West Africa in particular when there was a trade for gold against salt. And salt at one point was worth more in its weight than gold.
Wow.
Yeah, and I think it was like in the ancient Malian and Ghanaian kingdoms, where they would take their gold and then go trade it for salt because salt was the only way to preserve food on these long journeys. So,
I
yeah,
mean, that completely makes sense. Like, what are you going to do with gold if you don't have any food?
that's it. That's it. It's
You know,
like
like,
those sci-fi experiments, right? Where they get to the end, they've got nothing. The guy's trading 100 kilograms or 1,000 kilograms of gold for like one bottle of water, and then it makes it
yeah.
to the end, and they realize that they can synthesize gold out of base metals, and that it's totally useless too.
Yep. Exactly. Exactly. All right. Well, let's jump into this podcast on that note. I feel like this podcast might be a lot of that, which is all interesting stuff, right? But anyway, everyone, welcome to this episode of Midcurve. Today we have someone on who you may not know because he's really not active on Twitter like the rest of us are. He has a real life and he does real things. He doesn't hang out with his internet friends all day. However, he has been moving in the crypto space for a very long time and moving behind the scenes. So, Gordon, can you give us an introduction to yourself and start like honestly, man, I should tell everyone. Whenever I like talk about you to colleagues or whatever, I'm always like, this guy's the most interesting man in the world. So start with at the beginning because I think I remember you talking about like when you were coming out of college or something, you were trading, like or you were mapping volatility surfaces of Mexican soybean futures or something like that, something crazy.
All kinds of esoteric stuff. Yeah, sure. We'll start from there, and we'll take it to where we were, just like the coffee plant
Yes.
anecdote. Yeah. So I'm Gordon Grant. I am an independent trader and portfolio manager in crypto derivatives. That is true. I've certainly traded a lot of esoteric derivatives and options specifically throughout my career. I studied econometrics and quantitative finance at Princeton University, a fine formerly New Jersey state institution. Went into the trading world as a derivatives portfolio manager at a large multi-strategy macro hedge fund, and started doing emerging market foreign exchange and then fixed income. And then, of course, that led to commodities, which all these countries export, and credit products and interest rate options and equity index fall along with it. But heavy focus on commodities. In many cases, those kinds of countries, there's a strong relationship between their currency valuation versus the dollar or a trading partner basket and the price of those commodities, right? Copper in Chile, for instance, or, let's say Ghana at some point had a relationship between the SETI and cocoa prices and gold prices. And quite naturally, if you're spending a lot of time analyzing the balance of payments and microstructure of those economies, you can learn a lot about commodity markets too, and have a good edge to trade derivatives in them. So started doing that, from when I was right out of college, and came to understand that most people who were trading things like let's say life cocoa futures and futures options didn't really understand things like, second, third, fourth order moments of a distribution, and that there were good trades to do in understanding, let's say, the relationship between the level of cocoa spot or futures prices and the level of volatility, or the prediction of the options market as to what would happen for some path in the future. And that carried me for almost 10 years, until I stumbled into this weird thing called Bitcoin in 2013, and kind of said, hey, this looks a lot like an emerging market currency, sort of looks like a commodity. Nobody knows what to do with it, and began trading it independently myself and encouraging other people to speculate on it and trying to find interesting ways to use it and get other people to use it. But no options, right? No derivatives on it, just sort of a pure high vol spot market until lo and behold, in 2019, 2020, Deribit comes along, institutional trading in crypto options becomes a thing, beyond, let's say, just a narrow a window of CME liquidity. And I found myself back in the seat at Genesis Trading, doing quantitative volatility modeling and making markets for some of the biggest players in the crypto industry. Fast forward 3.5 years later now into 2024, left my Genesis days behind me and am focused on managing a set of separately managed accounts for some of my largest clients that I had at Genesis, who have crypto, have needs, and need to think about the relationship between Bitcoin and the price of Bitcoin and options on Bitcoin and other kind of macro factors that drive Bitcoin or Ether or other cryptocurrency prices. But still very much doing what I began my career with, which is looking at esoteric option markets and trying to think about them more intelligently than other people, and hopefully realizing certain things about how inefficient they are, longer or sooner than other people do.
Man, what a freaking intro. That's crazy.
And I left out all the good stuff too, right? I didn't get into the part about exporting scrap catalytic converters from West Africa, and paying for it in Bitcoin. There's all sorts of stuff in between. I just tried to keep the real derivatives focused stuff. None of that garbage.
You left out the part about actually trying to bring coffee on chain for
Yes. That was a great project. One of the things I'm proudest of was in that interim period, I kind of skipped over it, right? Bitcoin, I discover it and have my come to Jesus moment, try some Bitcoin specific stuff, try to build a little exchange. It was called an Obsidian, raise some money, got to know like Charlie Shrem and these other early Bitcoin guys. And then realized, I'm not going to build anything great in a value in this space. Like, let me just cash out, keep some crypto. That's probably going to do best. And then go do interesting crypto adjacent things. And started talking to people about how blockchain could be used for, different projects. And obviously Bitcoin itself is a commodity, sticking assets on chain like RWA before that's really too much of a thing. And as it turns out, if you went and talked to people about blockchain in, the mid to late teens, most people that were interested in it were either agricultural people or energy people, right? Like a lot of the enterprise blockchain stuff at that time, it wasn't even finance stuff. It was, really kind of basic. And one of the projects that I got through a random consulting connection was an East African coffee board, where they came and said, hey, right, like, we produce a lot of coffee. We feel like our growers kind of get scammed. We don't know how to measure the margin that's really being produced at the final retail phase. We don't think that we have a good access point to it. We feel we have a premium coffee, and it's not just garbage Arabica or, a Robusto that gets sold out there. And so how would we do this? And I went and pitched to those guys, well, listen, the simple solution for that is to create some common denominator. I called it a standardized caffeinated unit, right? And we have standardized caffeinated units of your coffee that we can basically track from the moment that they're produced, roasted, ultimately ground, and distributed at the retail level. They didn't go in for that, but they did pay me a nice consultancy fee, and they created their own coffee brand. And it's in North America, and it's called Bourbon, and you can go shop at one of their stores on the East Coast. I think they're mostly in DC. It's the Rwandan, national like coffee distribution franchise. Their solution was, instead of putting it on chain, they should just own retail coffee stores. And not a bad way to go. But I remember proselytizing them about the merits of doing this. And you know what? It may come right round in the end, but for sure, pitching blockchain to people in places as kind of far off the beaten path as Rwanda and as a solution to problems like that, it does help you understand what the technology does and is capable of. Definitely.
Yeah, that's interesting. So not to derail this conversation a little, too much, but I actually have a friend who now is bringing carbon credits on chain, and you always have some like area thought on just about anything that I bring up. So what are your thoughts? I just want to get your thoughts really quick on this. Like, what do you think about carbon credits being on chain, and like helping farmers actually make a little bit of money if they're producing? Because like their idea is like, okay, these farmers actually have excess carbon credits because of the plants that they're growing, but corporations need these carbon credits, so they set up a marketplace. Do you have thoughts on that?
Big time. And I promise to all the viewers out there, this is not scripted. Justin doesn't know this. And this is also not a scripted reveal. I actually raised a couple $1,000,000 to do an on-chain carbon credit project
Oh
in
my
the
God.
past. That was also left out too. But I did it. It was called Paris. And I did it from, sort of the pre-Genesis days until I joined Genesis and really didn't have any more time to do it. And then I would say that the kind of tailwinds of carbon offset trading and credit trading, became a little bit fraught as a function of geopolitical issues like wars in Europe that necessitated stopping using clean natural gas and burning coal. But I think it's a great project and it's the best way to do it. Let's take kind of a history before we do that of carbon credits on chain as a thing, right? Mine was called Paris Protocol. I thought it was amazing, and I'm still going to do that someday. But there were others that came before me that had varying degrees of success. So one was called Klima DAO. You guys may remember this thing. It was built essentially on the Olympus DAO framework, right? So, the Ohm construct, which was highly dilutive. It was really kind of a yield farming exercise. And the idea for Klima was they would issue tokens of their own and then buy so-called BCTs. Sounds like BTC, but not BCT, a base carbon ton from another protocol called Toucan that was using a third-party verifier to kind of stick these credits on chain, and then Klima would buy them and manage them as some sort of reserve. Well, guess what happened? Klima token prices went from they spiked to 2,500 and they went to more or less zero, right? It didn't work because of this sort of carbon credit reserve, balancing mechanism. Didn't make any sense, right? Like the Toucan, BCT prices were like $15 a ton, and Klima tokens were like 2,500. So why would one support the other? So there was that. The second one was called Nori, and Nori was a more, I would say, kind of idiosyncratic method of verifying something and then attesting to it and generating a decentralized consensus mechanism around the sanctity of that credit. Good idea, hard to scale in practice. What I was working on with Paris was basically a mathematical, distributed compute function gathering data from heterogeneous sensors like satellites, weather stations, power plants, national, emissions databases, and trying to arrive at a probabilistic, kind of balance of all outcomes. Like, what's that probability cone forward looking on the emissions of a given actor, right? Someone that's doing something, as you say, a farmer. The farmer's behavior, one, does it represent a deviation from what they would have been expected to do, right? So let's say take a piece of wilderness in Siberia, was unlikely to get cut down, right? So probabilistically, it was likely to persist and stay there for a while and be a carbon sink. Probably doesn't deserve much of an offset. But let's say a patch of ground in the rainforest, probabilistically, based on the data that we would gather, the ground around it is getting all burned down, right? And that carbon sink is going to turn into a net carbon emitter. So someone that takes the effort to prevent that and demonstrates through continuous logging of data about the persistence of that carbon sink, they should deserve a much bigger credit, and there should be a different incentive and reward function. And the math behind Paris, as I built it, was intended to do exactly that, right? It was to kind of make a weighted assessment of all available and knowable data that's sort of contributed and crunched by different actors who are doing this via a decentralized consensus mechanism. And that, to me, is kind of the right way to do carbon on chain. Now, today, right, there are active carbon derivative markets in many different places. There are EU emissions offsets, there are North American emissions, there are Chinese ones, and there are big players like BG Cantor who are kind of creating derivatives around this process. I still think that the best way to do this is putting it on chain, and anybody who's spending time on that now is pursuing a worthy cause, right? Provided that you pay attention to the quality of the credits being generated, the fungibility of the credits, meaning it's quality, but another market won't take it, right? For whatever reason, if I'm an emitter in Europe and I want to buy an offset from another geography, can I do that? Does your protocol solve for that pain point? And then the third is, kind of how transactable are these things that I'm putting on, right? Is it just dead money and I can't find another buyer for it? If I do well and let's say emissions offset prices go up 10x as they have in the past, can I unload it and monetize that value? So as long as you're solving for that, I think it's a great prospect, right? And it's a really another good sort of RWA example, right? Like forget my coffee thing or other things that I've worked on. It really does solve the, kind of disparate actors, a lot of data, a need to sanctify something in an immutable way, right? So we can't change it and say that credit was good, this credit was bad. We agree on it, and we move forward. And I think it's kind of a public policy problem that policymakers won't solve because they're too busy fighting wars and exporting weapons and doing whatever else is going on in the world today. That's kind of sad, but is a reality, but can be solved for by a network that has a certain objective function. So I think this is great. And that's awesome that there's more money coming back into this.
That's cool. Okay. So I feel like we could continue on this track of thought. We could get into falconry. We could get into coffee. Like we share this love of like odd things, falconry, fine coffees, traveling, obviously. And, we could get into your days of living, in the Middle East. And how,
man, we could.
By the way, like how many languages do you speak?
I speak 4 fluently. Ones that I'm kind of up and conversing in, that I talk to people on a regular basis in, like in a given day. So that's English, obviously, Arabic, yes, Persian and French. So that's 4. And I would say in any given day, I kind of rotate through those with varying degrees of proportion, depends who I'm talking to. And then there's a smattering of the others that I like, but I haven't spent enough time on to really be proficient in. But that are either transposable or just kind of ring on my ear. Yeah.
Sorry, go ahead. I don't want to get into. I do want to get into this, but we need to get into like some meat here. But why did you go with Arabic? Because was that your second language, I guess?
No, so it was French. So I did the reverse. I did the colonial trade, right? It's well, if you want to get into Arabic, start with French, and then you learn about all these horrible things that they did to people, and you realize that most of them were to Arabic-speaking peoples. Just kidding in part, but no, French was certainly a gateway for me into the East, because when you learn about French, French, they had this fascination with what they called, l'Occident, the East, and a lot of that was, North Africa. And here's the funny thing: the French call North Africa the Maghreb, and Maghreb is derived from the Arabic root, which is Gharb, which stands for the West. And if you talk to a North African, they will be incensed that you call them the Maghreb, because they say we're not the Maghreb, we're the North, we're not the West. Like, what are you talking about here? This is a terrible, misappellation of our whole people. But you learn about all that, and of course, then you naturally fall into learning about Arabic stuff. But in point of fact, Arabic was actually the 4th out of all of those, because I learned Persian, Farsi before Arabic by dint of my wife, who, if I did a 360 on the library that I'm sitting in, you would see about quick tabulation, about 300 books that are mostly in the Farsi and Arabic languages. So I definitely had a power head start on Arabic, because 30 to 40% of the vocabulary is shared with the Persian language.
Interesting. And why you lived in Iran?
Yes, lived in Iran, spent time around the Persian Gulf region, spent time in Azerbaijan, as well as UAE and Oman. So you can pretty much do it all there. I mean, Persian is mostly spoken in Iran today, but it's also still spoken in Afghanistan, parts of Uzbekistan, and some of those those other Central Asian countries, as well as a little bit in what would be called the Caucasus, right? So like Azerbaijan and Georgia. And then Arabic is mostly a sort of south of Persian Gulf thing in an area known as the Khalij, although it's also spoken in Iraq, Syria, and then East Africa, to your point, right? Ethiopia, Sudan, and other areas.
Okay. I could pull on this thread all day. Because
And then
just
we
to
can
give,
get into signal processing about it, and then doing
yeah,
signal processing on chain. But let's not get there.
no,
It's too crazy.
we're not gonna get into that. I mean, just to give you some context, I get these text messages from Gordon, like far and few between, but some of them are like, I remember maybe it was last year, you text me, you're like, hey, do you know anyone who's into falconry? I really want to get into her to flying birds. And I was like, actually, yes,
Plus,
I
it
want
so
to,
happens.
yeah, as it so happens, I'm into falconry too. Or yeah, it just or just like I remember just getting these random text messages from you like, hey, I'm in Georgia right now. Check out this fly. Check out this. And I just
Yeah, but it was beautiful.
it was beautiful. And I absolutely love that part of the world. And so it's always awesome. It's like we used to joke when I was at the last company, it's like, we're in the world is Gordon Grant right now. Because it was like I remember like another just quick anecdote. We were supposed to film a podcast with you. We thought you were in New York. At the office or whatever, and you just like call in from the road. I don't even know where you were. It was like either Georgia or the UAE or something like that. I think we had just talked.
It was probably Georgia. That trip included the UAE, but yes, no. You know where I was? I was driving from Tbilisi. I was driving from Tbilisi to to
Yeah,
this resort, man. There was like a biblical flood. I think
yeah,
that was the one where I thought we were all going to die.
yeah,
But good cell signal. Unlike North America, you can go almost anywhere in Georgia, which by most accounts is not high on the Human Development Index. But their
yeah.
cell phone reception is extraordinary. I will say
It's
that.
that was impressive. I'm not gonna lie. Okay, we're already like 20 minutes into this thing. I knew this was gonna happen. I was so excited last night thinking about this podcast because it's like we could just ramble. I think you and I could just go off for like a couple hours on this stuff.
That's right. People may
But
tune out, but we'll still be talking.
yeah, yeah, we don't care. We're just here to hang out.
Yep.
Let's talk about what we talked about yesterday, actually, and the reason that we got on this podcast was, I want to talk about Solana and institutions. You are heavily entrenched in like that world, right? And I think most people in Solana, we kind of covered this yesterday on our call, but most people in Solana, let's say they're not as financially sophisticated as like maybe the people who are moving money in Bitcoin or Ether at this point. Solana it's a little bit nascent still, a lot of meme coin stuff, but I think it's starting to evolve into this next, level, as it were, of maybe institutions and family offices are starting to kind of take a look at it. And that's your world. Up until this point, though, I've had conversations with family offices and like especially Chinese family offices, and they are really not interested in Solana at this point. So I was going to ask you, why do you think that is?
Well, I always start with what is an investment decision for for a person of an institutional capacity to enter a product at kind of a market price where they're not getting alpha as a function of their entry point. And I think that's Solana today. Not to say that Solana doesn't have bright, wonderful prospects for the future as a function of a great community, builders like yourself and Jito, people that are doing other dApps that are not related to financial considerations. But the fact is, Solana's 150, 160. It's not 15 or 16 bucks, let alone 15 or 16 cents. And institutional allocators today, I think, are kind of looking at it and saying, well, it's less liquid in some respects than certainly Bitcoin or Ether. It's had a huge run. People always look at 10x and kind of get sticker shock over a short period of time. And it's a separate chain, right, that they probably know less about. They know less about Solana's kind of hybrid proof of history, proof of stake consensus mechanism. They hear certain things such as the Solana network stopped working for a day. Gosh, that was scary. And I don't know what would happen if that happened again. Would my coins be safe? Sort of thing. So I think all of those, are kind of putting Solana in some people's minds into a more nascent chain, right, and a less well developed chain. I think the other fact is that Bitcoin is starting to be used for real world activity. Maybe not ones you hear about a lot, but let's say national oil companies are selling their oil for Bitcoin nowadays. Governments that need to settle or parastatal actors that need to settle obligations between them are using Bitcoin. So there's that. Ethereum continues to kind of be this thing on which people are always building. And then there's Solana, and you kind of go, well, what's happening there? So I think for the alpha acquired participant, it's a harder buy-in to kind of go, hey, let me do this today. And then the last argument is two things. It's either risk-adjusted return, right? So you go, okay, baseline case, I get into Solana today. Here's where I could stake it, right? And what sort of yields would I compound if I did this? Or I did some other interesting trades, like buying a 3-year wrap note on Solana from an OTC counterparty at a 50% discount to market, such as was in the space, kind of a within the last year. And that's interesting. And maybe that's alpha in and of itself. And you get some new institutional capital. Or the last one is sort of event driven, right? You get some event driven where people say, okay, hey, it's expensive or it's gone up a lot, but this particular thing can happen. So, there's an educational process about the chain in and of itself. And I think until it sort of seasons, and in a weird way, right, it becomes more attractive the bigger it gets. And that's sort of where Bitcoin is now, right? Bitcoin 1.2, 1.3, $1.4 trillion chain, depending on the day. It's so big now that people just go look at it and, well, it's liquid, right? And a big catalyst could clearly be Solana flips ETH, and then all of a sudden there's, another $1 billion of institutional capital that wants to touch Solana. And they go, oh, and by the way, the staking yields are great. And there's a, well-developed, LSD or restaking infrastructure for it. And hey, by the way, there are options on Solana on Deribit that you can trade. Did you know all these things? And maybe at that point, there's a CME Solana product. There's a liquid North American Solana ETP that has options. And so it's like it's kind of got to brew, right? It's got to age, right, to get in there until that concoction sort of reaches a stage where people taste it and go, this is good. I want some more of this. Not like, whoa, that's strong, man. I got to put that back down.
Yes, exactly. I kind of agree with you on all fronts there. We talked about this yesterday a little bit, but let's say that. Well, first let's back up. What are institutions and like MFs, the people that you work with and consult for? What are they really looking for? Are they looking for yield? Are they looking for, just massive upside?
Yeah, each of them can be different depending on the personality, right? Family offices, let's say, that have built a significant amount of wealth in an industrial enterprise or a non-crypto adjacent business. They may have a very different risk profile than someone, let's say, who's built a significant amount of wealth in a Bitcoin, right? Bitcoin mining, or has been a Bitcoin holder and, from inception has been a Bitcoin proponent, a Bitcoin whale, a Bitcoin Jesus type of personality. But I think the way that they would look at it is by tiers of allocation, right? They tend to feel pretty good about Bitcoin. They feel safe. They feel like they know it. They feel that it's liquid and hedgeable, that at any point, if they want to, they can just go and sell a bunch of CME futures or other, futures and kind of get back to synthetic dollars and not really have to lose much sleep. And by and large, most of them sit on their Bitcoin and don't really tend to hedge for the downside, right? Absent systemic risk events. But when they look at something, like a Solana, I think the first question is, if they don't already hold it, is what are the distributional characteristics of Solana, right? What's the beta of Solana to Bitcoin? What's the correlation? How stable have those been over time? Can Solana provide alpha over Bitcoin? Let's break it down for the listeners here a little bit. I think we probably all know what alpha and beta are, but in real simple terms, everybody knows what a linear regression is. Okay, if you don't, plot a bunch of points of returns of Bitcoin on one axis and returns of Solana on the other. And we're going to look at like a scatter plot of those things on a chart. And if we make that scatter plot of Bitcoin returns here, Solana returns here, and we draw a line through them, right? That line is going to tell us alpha. That's the intercept, like where that is in and of itself. That's returns to Solana that are statistically unrelated to the returns of Bitcoin. And then there's the slope of that line. We call that the beta, right? Which would tell us, all else equal, for a 1 unit change in sort of Bitcoin returns, how much are Solana returns likely to be. And this is how we kind of think about the world in a more sophisticated semi-institutional mindset. And if that alpha of Solana is high, and there are reasons to argue that it could be, people would start to go, well, hey, look at this, right? Like Solana, it's got a lot of, we say statistically robust alpha, right? If you want to sell something to a family office, you go, hey, listen, my strategy, very statistically robust alpha. You guys got to take a look at this. Or Solana in and of itself, right? And I think that will catch people's attention, particularly if we see it in the context of other trends. ETH BTC ratio, right, has just been coming down over, a period now of a year plus from 0.07 to 0.04. And Solana has continued to perform. People pay attention to that. A persistent alpha of Solana above Bitcoin returns. right? Past couple of days, it's been interesting. Solana has been up, right? Nudging up to the 170 level. Ether got rejected at 2750, right back on a 26, mid 26 handle, and Bitcoin also getting sold against 69. So, hey, Solana's got different price dynamics that aren't totally driven by whether people are buying or selling Bitcoin or ETH. So those matter a lot. And then I think, what's the persistence of them, right? Is it a one-off flow? Is it a new thing, right? Is there something driving Solana price appreciation? Could it be an NFT resurgence? Maybe, right? We know that has an effect on some chains. Is it a phenomenon like liquid staking derivatives, restaking? Is it the yield? People go, hey, like this big, 50 plus $billion chain, and you can get, upper single digits yield just for sitting on this thing, right? Liquid staking. Hey, that's interesting because I get zero on my Bitcoin. Real-time conversation I had with somebody today. I said, hey, you can get 12 to 15% using a sensibly managed derivative strategy on Bitcoin. Person says to me, but how do I mitigate my counterparty risk for that? It's an exchange, it's an OTC counterparty. I think I might just take my Bitcoin and lend it to BlackRock for 2%. And I went, oh my God, this is really tragic. So people do, and this is an institutional participant, right? High grade, this is the stuff that they think about. So clearly someone like that is going to go, well, my opportunity cost of capital, Bitcoin, I'm only getting 2%. Maybe I take a little bit of my Bitcoin, stick it in Solana. Because if my world is, I'm so scared, I don't want to do derivatives, I don't want to do listed or unlisted, but I would stake it or I would lend it to what I perceive as high credit quality counterparty. These things start to matter too, right? Your current yield, because institutional capital tends to say a little bit is reserved for geometric gains, right? Where I say, okay, that X factor that could make a 10 times multiple on a position, great. I like those if it's statistically robust. And then the other is, hey, am I getting good yield for this thing? Relative to other alternatives. And when you look at what does Bitcoin pay you today, okay, 2, maybe 3, 4, 5, if you're going to a lower credit counterparty for lending. What does, ETH pay you today? Okay, mid to upper single digits. If you're doing Athena, you could argue that's sort of an ETH type yield, and that could maybe get you a lot higher in certain conditions, but people would say that carries some risk. And then, hey, there's Solana, and so that's interesting too. So I think it's a mix of factors, quite clearly, that drive these kinds of decisions. But the longer something persists, and the more differentiated returns there are, as well as the more elevated, kind of a justifiable risk premium there is, the more people start to look at it. And it's like EM currencies, right? When I started trading EM currencies in 2005, people were looking at the Brazilian real and going, this is crazy, man. There's a currency where if you just deposit it in like a T-bill, you get 15%. And people will go, huh, sounds high. What's the inflation rate? Oh, it's 10%. And you go, 10%? That sounds scary. But you're like, but yeah, the real interest rate is 500 basis points with no credit risk. And people started, yeah, I don't know, man. It sounds like a risky bet. You can be sure that by 2008, just before the financial crisis blew up, the currency had appreciated 40%. Yields were down to 8. Real interest rate differential had narrowed from 500 to 150 basis points, and everybody was piling into the trade then. That was the moment they were going in. So there is that herd effect as well, right? It just has to season. It had shown good alpha, right? That the real continued to go up in spite of the vicissitudes of the geopolitical and macro background. Yields were above dollar rates. It had good kind of alpha, had good static returns, and then it really started to suck in the institutional capital. And I think Solana's a little like that, right? Got to give it some time.
Yeah, give it some time. Yeah, I mean, from the people I've spoke to as well, it's like, obviously, like, I would love people to be staking with Jito, but...
And I'd love them to be trading Solana derivatives with me to earn, 20% on top of their Jito stake Sol. Then we could all have a big party on a yacht at the next break.
Hold on. We're going to get into that. Because I do want to ask you about that. What I was going to say, though, is like, there is like this potential for ups, in my opinion. Okay, this is not financial advice by any means, but there is this potential for upside that could outpace, like, let's say my yield. That, like, say I just stake with Jito, I restake, I get, that's the safe play. And so for me, like, I like doing that for like part of the portfolio, but the other part is just like, I mean, when you have an asset that could potentially like double, in the next 12 months, you're like, why not just hold it and, take some of that risk, right? So I think partly for the people that I do know, that are like maybe not, whales or family offices or whatever, maybe they're not at the institutional level, but they do have some bags they're more of the mindset like, I'm not going to stake this. Although you could stake it with Jito and still get that upside. There's still people who like, they don't understand it. So like, I think one of your points, like it's an education thing. And then to like alleviate some of the worry around counterparty risk, it's a time thing. Like it has to become
Yes.
Lindy, right? But this is what I want to talk with you about. This is the second big topic we want to talk about is like, for me, I like staking with Jito. You get 8% on your token, but you're also exposed to price risk, right? If I wanted to lock in just my 8%, I could somewhat go delta neutral by just shorting some Sol. Sure, it's not going to be perfect, but you know, there's somewhat of a hedge there, right? Now with our new restaking product, I can then restake that token and earn another, maybe 8%. I don't know. Don't quote me on that because it's going to be different, but like, let's just say it's something around there. Now I'm earning, somewhere around 15 to 16% on my Solana, which isn't bad, right? Now, is there a way, if we were like, let's talk about your strategy then. What would you do? How would you use derivatives to maybe even enhance that?
Yeah, I mean, typical kind of treasury management strategy that I look at for an allocator is predicated on a couple of things. One, path dependency of these assets that we're all talking about here, which is to say, yes, Solana over the last 5 years has had tremendous price appreciation with some incredibly wild swings. Right? We did I guess Solana basically had a 95% reduction from the 2022 peak.
But
and that was due to factors that
like it kind of followed the same path as like a Bitcoin or an ETH, right?
That's right. Just more extreme because there was less liquidity and there were idiosyncratic factors that were driving Solana liquidations, which are now well known and we understand them. But the price, the price trajectory, notwithstanding this huge amplitude, right, has been upward, and the same is true of Bitcoin. And so the first thing is, in excess of that upward trajectory, and in recognition of that amplitude, just how much return is there to be harvested, right? I mean that's a fair mathematical question. High vol assets with big amplitude trajectories leave you lots of room to be able to do that, provided that there are kind of consistently liquid, observable derivatives markets for that, for which there exists for Bitcoin, and which there again, I would argue, has come to exist for Solana, right? There was a Deribit options contract right up until the FTX blow up. And then it kind of broke the weekend of breakpoint in 2022. That's a funny name, not a great name. That was like the breakpoint for the whole market. But it happened. And I remember Solana went from like 28 to 38, and then it went to 8, and implied volatility went to 1,000, and the market shut down. But we're back now to a point where you can reach out to 3 or 4 OTC dealers, get a price, benchmark it against listed Solana options, and there is observability. So that's the third. Like I would generally not advocate getting involved in options for people unless there's a liquid observable market, and I think there is for Solana, and it will continue to get better.
Quick question, because I'm out of the options game, have been for a while since I'm American, cannot trade options on Deribit. They kicked me out years ago. Where is the main options market right now for Solana? Is it Deribit or
it is Deribit again, as far as an observable place. The volumes there are still relatively paltry, but there are blocks that are trading on OTC as a function of the following fact, and this is all publicly knowable information or announced information. FTX estate had a huge bag of Sol. That bag of Sol appears to have been hedged, distributed, repackaged through a series of OTC transactions, where that was sold on a forward basis to whoever at whatever terms and conditions. But it created a market where people were sort of long Sol on a forward basis now, and you've got dealers that are managing risk around that. And then you've got folks that have kind of wanted to play for the return of price appreciation of Sol off the bottom, i.e. that's option buyers, and guys that are long Sol for the long term. Perfect. And an estate that needs to collar it, hedge it, do whatever. So you've got option demand, option supply, and market makers kind of getting a sense for where the price is, some stability in this mid hundreds range. And that's bringing a market kind of price discovery opportunity where people are going, yeah, hey, Deribit is sort of here, and we can all sort of trade around it. And the implied volatility is sort of around, 80 plus or minus, right? It's been up in the hundreds when it really gets boogieing. It's been down into the 70s, I think, for brief periods of time. but there is a general kind of consensus as to where that is. So yes, Deribit, but OTC I think is principally driving Sol as far as I see for the people that I talk to and work with. So yeah, strategies that are going to look at this and say, okay, so statistically Solana a bit different than Bitcoin, right? It's still quite a bit more kurtotic, i.e., it's got these fat-tailed outcomes, right? Those have sort of mitigated for Bitcoin over time. If you look at the history of Bitcoin, 2013, Bitcoin ran up from basically, $10 to like 1,000 in a pretty short amount of time, into that period. Not all in 2013, but leading up to it. And then Bitcoin had a 90% price correction, right? Went from 1,000, over 1,000, all the way back to just a shade over $100, and then built up from there and went up to almost 20,000. And from 20,000, it went back to like 3K, 3,500.
Yeah.
And then went to 70,000 and then only made it back to like 15,000, right? So the corrections have gotten smaller in percentage terms. We haven't seen a full-scale systemic washout in crypto yet, but, I tend to believe that it will not be 75%. It would probably be a lot less. So that kind of harmonic oscillator has been dampened for Bitcoin. We don't know what the next one will look like for Sol. I suspect it will be a lot less than 95%, right? And so people are kind of starting to say, and probably also that it is not likely to have a 1 year 10x move again, right? May have a 1 year 2 to 3x move again. So we think about the kind of strategies you calibrate as a function of the future path of volatility. And that's what I mean by path dependent, right? The types of trades that you do. And for folks that I'm talking to Solana about, the data analysis suggests that trading strips of calls and kind of ratio spreads, i.e. buy one call, sell one, sell two calls, and also overload that with a bit of front end call selling, is capable of generating returns in, the upper teens to low 20%, right? Again, if you hit all your numbers and you don't have anything called away from you. If you do, and you get sort of a geometric price in Solana when you're running this strategy and, you're not using the right kind of conditional distributional assessments, maybe you get dinged, you have to roll or close some options, but you're still going to come away with mid to low teens, right? Even in a conservative scenario, I think. And that's, not surprisingly, it's kind of comparable to what you're talking about for staking plus restaking, right? And there is some inherent parity between these two because, at least until this year, for most assets, if you staked it, was hard to use it as derivatives collateral. If you used it as derivatives collateral, hard to stake it. I think now dealers, prime brokers, other kinds of financial intermediaries are starting to ask this question, which is, well, got a client who has this staked asset, be it ETH or SOL or whatever it is, and also wants to kind of double or triple dip on top and sell some call options. Well, it is sort of available, right, to me, if once it comes unbonded or it comes out of that LSD. But what's my gap risk on that, and how do I haircut that? And I don't think people really know what that number is or should be. I've seen different proposals for different types of solutions for that, right? I've seen OTC market makers who are also node operators make certain concessions to say, hey, if you stake on my node and enter into certain kinds of options trades, I can offer you the following type of collateralization terms. But certainly those are by no means across the industry. But I think as those become more standard and people generally arrive at an agreement of what that staking means, there will be opportunities to have staked assets and some derivatives overlays on top of it. So that kind of relationship inherently makes sense. And there is that substitutive consideration at work. And it's not just Solana for which this is true, right? We probably, most of us who are in the derivatives markets, remember the huge ETH whale overlord overwriter of 2023. And there was this guy who decided, a guy representing sort of an agglomeration of interests, that he would, kind of try to double dip and have some staked ETH and then overwrite calls and then cut his margin requirements by being long perps against it. And before you know it, you've got a dog's breakfast. And he created absolute havoc in the ETH options market. But, for him, he kind of looked at it and said, well, hey, I can stake my ETH and get X. I could overwrite my ETH and I could get Y. Even if I absolutely demolish, the term structure of volatility and term structure of skew, and I'm getting Z annualized percentage points less for engaging the strategy which generates Y, because I'm getting X for staking, my indifference curve is way lower. And I'm just going to keep hammering these calls until it blows up in my face. And sure enough, that's what happened. But people tend to think of it a bit as an either or, right? Could have some staking, could have some dynamically managed covered call or overwrite strategies, which is what I tend to focus on. I think of it as treasury management because it's really a bit more nuanced than just whacking out calls. But there is a substitutive effect there, right? Do you want the apple or the orange, or you want a bit of a fruit salad?
That's right. Yeah, I remember back when I could trade on Deribit, the 1x2s were my bread and butter. Love that strategy.
They tend to work very well. Conditional, use that word, right? Conditional distribution of forward-looking outcomes for 1x2s is statistically robust under certain sets of assumptions about the overall levels of vol and skew and basis, right? And that's what I spend a lot of time thinking about, right? Quite clearly. And even for a market like Solana, and that's why it becomes easier to make decisions from a portfolio management thought process when there's more data, right? Yeah. The data on the Sol options market is like this compared to Bitcoin, and Bitcoin options market data is like this compared to gold or crude oil or, for God's sake, S&P 500 index options, for which there's reams and reams of data. And things like the implied volatility skew almost never changes, right? Because people are so sure about it down to the 1/100th of a volatility point.
That's right. But that's where there's opportunity, right?
That's right. And we are the builders. We are here building those data sets and intending to trade and help create and bootstrap that liquidity. And that's that's all part of what it means. I think when people say, well, it's funny. My kid asked me recently. My son's 5 years old. I went to his school. And I did a little presentation about, like bring your parent into school and they'll tell you about what they do for work. How do I explain what I do?
I can't imagine Gordon Grant doing like a presentation of like what he does to a bunch of
Oh yeah, it was great. It was great. What's that?
Did you get into like second and third order Greeks or
no? That's for the next one. This was just the primer. But what I did do was walk in with a fully loaded packet of Pokemon cards and use them to introduce concepts of perceived scarcity, rarity, relative value, decentralized consensus, monetary transmission, medium of exchange, store of value, all this good stuff. We got it in there. One 20-minute class. But one of the things that I talked about with with these kids, and you had to explain. The teachers asked me, "What do you do for your community?" Big question. Who's my community, right? But I think we all, you at Jito, right? I'm out here as kind of a lone wolf portfolio manager now. But the fact that we're here having a discussion about relative value, yield, risk, implied volatility, options market liquidity, these are the kinds of things that will drive growth in this community. That, in a year's time or 3 or 5 years' time, people are going to look back and say, remember those crazy guys? They were talking about, liquid staking and Sol derivatives. And then it'll be like, well, here's Sol trading on the NASDAQ. Alpha Point has introduced listed Solana options that now trade in quantities of 10K units of Sol when Sol was like $1,000, right? And we're going, wow, 10 million clips of Sol options. So I think that is part of this exercise, right? I mean, I wouldn't be doing this if I didn't think that there was a brighter, happier future for liquidity, price discovery, data set quality, and again, to use that word, statistical robustness about the decisions we make for the capital that we manage.
Yep, that's right. You keep saying that you're overriding calls. What does that mean exactly?
Overwrite. Let's use a little bit of basic vocabulary. Overwrite is a strategy not unique to crypto, which means holding an asset, in this case, a cryptocurrency, a digital asset, and selling, i.e. conveying to another person, a call option, which is the right but not obligation, to buy an asset at a fixed price at a fixed date in the future. That is literally the meaning of an overwrite. It means by nature of having an asset, I am in a position to grant to someone else the right to buy it from me at a higher price. And the person who does that is going to pay me something, which is called the option premium. And that premium is either expressed as a percentage of the underlying price of the asset, right? So in Bitcoin terms, if you look at Deribit, it'll be priced in 0.01235510 of BTC. That's a percentage of Bitcoin. Or you could look at it in dollars, right? 0.1 of BTC is worth roughly $6,700 today. But that is what people call covered call. It's covered because you own the underlying asset and you grant the calls against it. Or overwrite. You are overwriting. You're writing on top of the asset that you have. In essence, selling a covered call it combines certain kinds of things. there's a delta component to it, right? When I sell a call, I'm getting a little bit shorter the asset that I sold the calls on, but not entirely, unless it's a deep in the money call option, meaning a call whose strike is way below where I'm selling. And as a general presupposition, we tend to be talking about calls that are not even at the money, but are relatively out of the money. That is, 10, 20, 30+% out of the money, depending on the time horizon for these options, because that's where it gets interesting. What's the right price for an out of the money option on a highly volatile asset for which we don't have great historical data, and for which the relationship between the change in the asset price and the change in the asset volatility is not fixed, right? And that really is where the magic happens. And you can kind of think about this as a 4x4 grid. Maybe we'll save this for another podcast, but what is to say, price up, vol, down, price down, vol down, price down, vol up. And that is a lot of my world on a day-to-day basis. That's also going to be in my next edition of Crypto Derivatives for 5-year-olds, after I get into the first, second, third, and fourth order moments of the distribution. But that's kind of the basis of what that strategy is. And that's really, what I do when I go to people and say, hey, listen, I'll do this for you. You need to pay me something for this. They ask me, but why would I pay you? I can just go sell calls myself. And I go, but let me show you this grid first. Yeah. And it starts from there.
Yeah, exactly. Yeah, it's a little more complicated than just selling some calls and hoping it all plays out. Because derivatives aren't priced, options aren't priced linearly. So people don't really understand that, right? They don't understand.
That's right. It's one of these things, it's simple to say, not so easy to do in practice.
Yeah, exactly. By the way, I need to join this derivatives for 5-year-olds class. I need to get in on this. So next time you do it, maybe you should just record it. You could put it so I can watch it and learn some stuff.
I'm talking to another journalistic outlet right now about how we can make this kind of a thing as a financial literacy program to get people into it. Because the best way to explain, even if you're in crypto, you might not know about digital asset derivatives. Is to explain it to a 5-year-old, because if they can understand it, then hopefully I've done my job. So I'll tell you what, maybe we'll make this a Midcurve, kind of quarterly thing, crypto derivatives for 5-year-olds, aka anybody who's never traded an option but knows a lot about crypto. Right. And we can have some fun on all of these topics. I obviously enjoy it immensely.
That's right. Perfect. I think let's end it there. We're at 50 minutes. Sir, thank you so much for coming on. It's always a pleasure.
You got it, man. Listen, this was great. I'm going to wrap up with my last sip of delicious Yemeni coffee.